September 2008. Lehman Brothers, a 158-year-old bank that survived the Civil War and the Great Depression, collapsed over a single weekend and took nearly $10 trillion of the world's wealth down with it. You went to bed with a job, a house, and a retirement account, and woke up to find all three quietly detonated. But what if I told you the whole disaster grew from one idea so cozy we printed it on billboards and called it the American Dream? So let's rewind to the party before the crash. Welcome to 2002. It's 2002, and America is nursing a nasty hangover. The dot-com bubble just vaporized a fortune. September 11th sucker punched the national mood, and Wall Street is twitchy. So the Federal Reserve reaches for the one lever it truly loves and yanks interest rates down to almost nothing. Just like that, money goes on clearance. Borrowing gets cheaper than a value meal, and America's favorite pastime stops being baseball and becomes buying a house. Why rent when you can own? The slogan is everywhere. Every billboard, every commercial, every mortgage seminar in a Holiday Inn conference room. Owning a home isn't shelter anymore, it's status. It's the American dream with a two-car garage. And the banks agree so enthusiastically that they start flinging money at anyone with a heartbeat. Congratulations, you're pre-approved for $400,000. But I bag groceries part-time. Even better, just sign here. Home prices start climbing, then sprinting. Your neighbor buys a plain little split level, and 6 months later it's worth 30% more for doing absolutely nothing but sitting there. Cocktail parties turn into bragging contests about square footage. Your barber is suddenly a real estate genius. Your dentist owns 3 rental units, and the guy who changes your oil just closed on a beach condo in Florida. It feels like the entire country stumbled onto a cheat code for getting rich. What could possibly go wrong? Spoiler, everything. But we're just getting started. Now, to keep this money machine humming, the banks needed more borrowers, and they'd already used up all the responsible ones. So they went looking downhill. Enter the subprime mortgage. Translation: a home loan for people with shaky credit, no steady income, or a relationship with money best described as complicated. Back in the old days, a bank that lent you money actually cared whether you paid it back, because it was stuck holding your loan for 30 long years. But the modern bank had a slick new trick. It didn't keep your loan, it sold it. Picture your mortgage as a hot potato. The second the ink dries, the bank tosses it to Wall Street, pockets a fee, and now whether you can actually pay is somebody else's problem. So of course they said yes to everybody. Should I be worried I can't afford this? Not our headache in about 90 seconds. Then Wall Street took thousands of these loans and blended them into one big product, like dumping good apples and rotten apples into the same giant smoothie and selling it by the cup. They called it a mortgage-backed security, and investors around the world lined up to buy a sip. But how do you convince a pension fund in Norway that a smoothie made of unemployed baristas and gym bros is perfectly safe? Easy. You get the ratings agencies to stamp it AAA, the exact same gold star they slap on the United States government. And here's the punchline they leave off the brochure. The banks were paying the ratings agencies. It's like hiring a food critic and telling him he only gets his check if he calls your raw chicken Michelin-starred. Funny how every plate turned out to be 5 stars. Then Wall Street got greedy and creative. They scooped up the leftover chunks nobody wanted, the sketchiest slices of the smoothie, rebundled those into a brand new product called a collateralized debt obligation, a CDO, and got that stamped AAA too. Garbage went in one end and gold came out the other, at least on paper. And then came the final ingredient, the one that quietly turned a housing problem into a doomsday device. A few skeptics read the fine print, saw the rot, and wanted to bet against the whole thing. So Wall Street built them a way to do it. Insurance you could buy on a mortgage bundle. Pay a small premium every month, and if the bundle blows up, you collect a fortune. They called it a credit default swap. The catch: you didn't have to own the bundle to insure it. It was like buying fire insurance on your neighbor's house, and then 100 strangers buying insurance on that same house, every single one of them quietly hoping it burns to the ground. By 2005, almost nobody was buying houses to live in them anymore. They were flipping them like pancakes, betting the next guy in line would happily pay double. I teach third grade during the day and flip condos at night. I just closed on my fourth house, zero money down, and I've never actually seen any of them. Real estate wasn't a home. It was a scratch-off ticket, and the entire country was scratching. And perched at the very top of it all sat Wall Street, stacking a Jenga tower out of bad mortgages, balancing each risky bet on top of the last one, and toasting every wobble with a fatter bonus. The whole tower was built of lies and leverage, and the men stacking the blocks were popping champagne. Why lose sleep over ethics when the money is flowing this easily? Whistleblowers got waved off. Regulators were practically asleep at the switch, and the guys running the show were too rich to care and too greedy to stop. The music was loud, the drinks were free, and nobody wanted to be the killjoy who pointed out that the floor had started to crack. Then in 2007, someone pulled the wrong block. Home prices, the one thing every single person swore could only ever go up, started going down. And the moment housing slipped, all those subprime loans buried at the bottom of the tower began rotting out in the open. The mortgage-backed securities built on top of them turned out to be ticking time bombs, and one by one, they went off. Banks that thought they were sitting on gold suddenly realized they were hugging radioactive waste. We can't sell any of this stuff. So what's it actually worth? Somewhere between very little and absolutely nothing. The first domino was Bear Stearns, an 85-year-old investment bank that evaporated in a matter of days in early 2008 and got swallowed whole for a humiliating fire sale price. Wall Street told itself that was the bottom. It was not, because in September the big one arrived. Lehman Brothers, that 158-year-old giant, was drowning in the exact same toxic garbage as everyone else. And this time there was no rescue, no white knight, no bailout riding in. Over one brutal weekend, Lehman filed for bankruptcy, the largest corporate failure in American history, and the message landed like a gunshot in a quiet room. If Lehman can die, anybody can. And then came the truly terrifying part, the part you could never see from your living room couch. The banks stopped trusting each other. Overnight, they simply stopped lending, and not just to you, to each other. Credit, the invisible oxygen that the whole economy breathes, just disappeared. I need a short-term loan to make payroll on Friday. There's no money to lend right now. What does that even mean? It means everybody's holding their breath and nobody's opening the vault. Perfectly healthy businesses couldn't borrow a dime. And remember AIG, that colossal insurance company that had cheerfully written all those credit default swaps. It had promised to cover so many exploding bundles that it now owed hundreds of billions of dollars it flat out did not have. If AIG toppled, it would take half of Wall Street down with it. So the United States government stared down one impossible choice: let the whole system burn to ashes or hand billions of taxpayer dollars to the very people who lit the match. In October 2008, they chose the money. How much do you people need? $700 billion. For what exactly? To shovel into the burning banks before the fire reaches your house too. They called it TARP, the Troubled Asset Relief Program, a $700 billion mattress for Wall Street to fall on. And the reasoning had a name you have heard ever since: too big to fail. Let these banks collapse, the argument went, and they'll drag the entire global economy down the drain behind them. So Uncle Sam grabbed a fire hose made of cash. AIG alone got over $180 billion. Even the car makers, GM and Chrysler, got tens of billions just to keep their lights on. And it kind of worked. The panic slowly cooled, the banks unclenched, the stock market scraped rock bottom in March 2009 and started crawling back up. Wall Street exhaled, but Main Street was still choking on smoke. So here is the final bill for the people who never got a bailout. Unemployment climbed to 10%. Around 8 million Americans lost their jobs. Roughly 4 million families lost their homes to foreclosure. Retirement accounts that took 30 years to build got sliced in half in a matter of months. Families who had never missed a single payment suddenly owed more on their houses than the houses were even worth. And the people who actually built the bomb, they mostly kept their bonuses. Wait, so he got evicted and the banker got a year-end bonus. That's exactly right. And people were furious. Wall Street was popping champagne on the balcony while Main Street stood in line at the soup kitchen. Not a single major Wall Street CEO went to prison for any of it. No handcuffs, no perp walk, no cameras. Just golden parachutes and quiet early retirements to houses that were very much paid off. So here is what 2008 really teaches you, and it isn't a lesson about mortgages. It's a lesson about how a disaster hides. The crash didn't show up wearing a mask, screaming that it was dangerous. It showed up as the friendliest idea in America. Own a home, build a little wealth, why rent when you can own? Every rotten link in that chain looked perfectly reasonable up close. The loan looked generous. The bundle looked safe. The rating looked official. The bonus looked earned. Nobody inside the whole machine believed they were the villain, and that is precisely why the machine worked. We didn't get robbed at gunpoint in 2008. We got robbed by 1,000 polite people in very nice suits, each one convinced the guy down the hall was the actual crook. And maybe the most unsettling part is the lesson the system itself walked away with. When the banks blow up, they get rescued, and when you blow up, you get wrecked. So the next time something feels too easy, too profitable, too obviously the smart move that everybody is already making, remember the billboard. Because the next crash won't look like a crash. It'll look like a dream, right up until the morning you wake up and find it quietly detonated while you slept.